first panel is going to look at the foreign tax credit regime. I think from a U.S. multinational perspective, everything's been turned on its head with not only the territorial system, but the elimination of 902 and the creation of these new baskets and the GILTI regime. The panel is going to be led by Pat Brown, who's going to introduce his panelists, but Pat is well known to just about everybody in the room. He's on the New York Steering Committee of IFA. He's on the Executive Committee of IFA. He regularly leads our programs, and professionally, he's the Vice President and Tax Counsel for GE Power and GE Renewables, and he's also the Director of Tax Policy for GE, which is an important position. So, Pat, you're set to go.
We were just busy dealing with our press. First of all, thanks, everybody, for joining us. We do have a lot of material to cover. When Peter and I talked about doing this panel, there were two things that I sort of really was insistent on. One was that we really needed more than an hour because this is obviously a meaty topic. And the second was that I really needed to have a first-rate group of panelists. So 1 out of 2 ain't bad because we got an hour and a half, but I couldn't get the first-rate panelists, so you're stuck with these guys. Kidding, of course, but this is actually, frankly, this is a dream panel from my perspective, a privilege for me to be up here with these guys. Starting on the other side of this rather small table, we're a very close-knit group, as you can see, is Michael Cavallero, a partner at Covington & Burling, a two-time alum of the Treasury Department, serving most recently as International Tax Counsel, and also a proud alumnus of the University of Notre Dame. So if anybody shouts randomly, "Go," during the course of the panel, after a few seconds, Michael is apt to shout, "Irish." So I thought he might actually do it. But anyway, this is a tightly choreographed discussion, as you'll no doubt find. Sitting next to Michael is Pat Jackman, former colleague of mine from GE, partner at KPMG. Co-author of one of the leading international tax treatises, and a proud alum, like myself, of the University of Virginia, which means that he is apt to outperform your expectations until the pressure is on, at which point he will turn into a quivering mass of Jell-O, just like the UVA basketball team. So, and next to him, and immediately next to me, Jose Murillo, partner at EY, also an alum of the Treasury Department, proud alumnus of the University of Texas, which means that he's a consummate gentleman to everyone unless you happen to tell him you're from Oklahoma, in which point he will ask you to step outside. So we do have a lot of material to cover. I'm going to jump right in. I think I'm supposed to drive the slides. Isn't that right, Pam? Okay. So just picking up on some of the comments that Peter made, do you recall what you were doing exactly 12 months ago? So 12 months ago was late July, of course. 2017, I would say most of us, certainly myself, speaking for myself, as Peter alluded to, we're preparing for U.S. tax reform. This, of course, was post the days of border adjustability. By this point, we had put border adjustability to the side. And what did we think tax reform was going to look like? Well, we were all quite confident that if they could actually get it across the finish line, we'd have a lower corporate rate, we'd have a territorial system which would effectively repeal the indirect tax credit, and we'd probably have some version of a minimum tax. That's what we thought. In fact, some of us would have been quite confident in saying that that's what we would have if, in fact, they got it done. What did we end up with? We did not end up with the foreign tax credit becoming less important. If anything, it's even more important than it was prior to tax reform. And I say that because in the days prior to, as all of us in this room know, in the days prior to U.S. tax reform, there were lots of companies, lots of U.S. companies who would, of course, make the decision to simply leave their earnings offshore, indefinitely reinvested. And if you made that decision, you frankly didn't care terribly much about the U.S. foreign tax credit system. That species no longer exists because now, with a very narrow exception, of course, all of a U.S. companies' earnings are subject to current tax, and the question is what basket do they belong in, courtesy of U.S. tax reform. So we moved from a two-basket world 3+ if you include treaty baskets, to a 4 or 5 basket world. Section 902 was, in fact, repealed. The indirect credit that we all knew and loved was repealed, but was replaced with Section 960, which Jose is going to walk us through. And as I say here, many of the existing paradigms that we had all gotten comfortable with actually were not eliminated in U.S. tax reform, though we would have thought of them as being much less relevant, if at all relevant, in a territorial system. They've effectively been retooled in this new system. In some cases, have taken on a lot more importance, but have been retooled in ways that, frankly, have given rise, I believe, to a lot of uncertainty. So we're going to have to work through that. And, you know, obviously, it's hard to have a conversation about the FTC in the new world without spending a bit of time on the guilty basket. And as I say here in my first bullet here, you know, if you just casually read the conference report, or like me and a lot of other folks, spend time talking to people on the Hill in the days leading up to the enactment of tax reform, you might have thought that the guilty regime was some version of a minimum tax, such that if your earnings were taxed above a particular foreign rate, you were simply not subject to the regime. That is, in fact, not what we have, as I'm sure everybody in this room knows. In fact, what we have is a regime that created a separate foreign tax credit basket, the guilty basket, but of course the basket that is unlike every other basket. And the details of that, I think, will make dealing with the basket very challenging, both for Treasury and promulgating guidance and trying to figure out how to breathe life into this, how to make it work, but frankly also for taxpayers and practitioners. So we'll talk a bit about that. And I'd be remiss if I didn't add that we're going to spend a decent amount of time today on the foreign tax credit rules as they relate to PTI. Michael has done a ton of work in this space. Again, thinking back on the world that we had prior to tax reform, I'll speak for myself, I didn't spend a lot of time in the arcana of the foreign tax credit as it applied to PTI. I picked it up when I needed to look at it and otherwise didn't give it a lot of thought. In a world where basically everything is PTI, you need to pay a lot more attention to this stuff. So Michael's going to take us through that. What are we going to talk about here? Section 960, Jose is going to talk us through that. I said why guilty is not really a foreign tax credit basket. It is, but it isn't. Again, it's a basket unlike every other basket. Expense allocation, Jose and Pat are going to talk to us about that. Michael will talk to us about PTI. Pat will talk to us about the 904, and Jose will talk to us about the look-through rules. And then we'll talk about how we might think about attributes that existed prior to tax reform, attributes relevant to the foreign tax credit, of course, that existed prior to tax reform, how might one think about those attributes, what might Treasury do with those attributes in the new world. And then just because I'm sort of fascinated by it, I insisted that we at least include a little bit here on treaties, which hopefully we'll get to, you know, if time permits. So without further ado, let's hop right into it and talk about Section 960, the new and improved Section 902, which Jose is going to take us through. So
thanks a lot, Pat. So 902 is repealed, right? It's repealed effective for tax years of foreign corporations beginning after 12/31/2017, and for tax years of U.S. shareholders that in which or with which such years end. Excuse me. So now 960, right, is the sole mechanism to claim a credit for taxes paid by foreign corporations under the new regime. Unlike old 902 now, though, 960 is only going to allow you credits paid by CFCs. So you'll never be able to claim a credit for foreign taxes paid by 1050 companies, which can be very significant in certain cases. There is now, though, no direct ownership limitation. So all U.S. shareholders of CFCs that have items of income included with respect to those CFCs are eligible for a credit, and there's no tier limitation, unlike the old rule. 960 does move away from old 902's pooling concept, so that is going away. There's still a little bit of confusion as to, for example, if you have E&P deficits that survive tax reform that carry over into the new system. You've gotten a lot of questions as to whether those deficits may prohibit credits being claimed under the new system. The answer is no. Pooling has gone away entirely. Instead, the new standard is identify the foreign taxes that are properly attributable to the item of income that is being included in gross income by a U.S. shareholder. That has generally been thought of as sort of a separate tax year. Each tax year stands alone calculation. So each year, I think you're generally intending to identify the foreign taxes that are paid on the income earned in that year, and that's how you're going to determine the properly attributable to taxes and the indirect credit that the U.S. shareholder is entitled to. 960 provides three different rules. 960A is providing the credit for inclusions under Section 951, so Subpart F income inclusions, 956 inclusions. 960B is the mechanism to associate foreign taxes with distributions of PTI as they move up a chain of ownership into the U.S. As Pat mentioned, the new system, and you say the backbone of it, is the PTI regime. So 960B is going to be very, very important. There will be some lingering issues, as Michael will go through, from the old system to the new system, because there certainly is a lot of PTI carrying over from the old system, including because of the massive 965 inclusion. And so it will be very, very important. Two different rules in 960B, PTI distributions directly into the U.S., as well as PTI distributions through a chain of ownership, again, between CFCs leading into the U.S. And then finally, 960D. 960D is the indirect credit for guilty inclusions. There's just a formula. It still adopts the same properly attributable to standard that you're identifying there, foreign taxes that are properly attributable to tested income of your CFCs. There's a formula, though, because you're not going to gain too much of a credit if you have tested losses that at the end of the day are reducing your guilty inclusion. So still the same standard. What are the properly attributable to foreign taxes? But in the case of guilty, the statute just provides a formula. You plug in the data, and that's going to give you your credit. So it kind of sounds a little bit more simple than the old system. But two sort of very significant issues that have arisen are, number one, yes, you can kind of think of this as sort of each separate year is a separate calculation, so one year is different from the next. But what if there are significant timing differences, right? What if a CFC is earning income in 1 year and it's being included in gross income by a U.S. shareholder in year one, but for whatever reason, the foreign taxes are not paid until later years, year 2, year 3, year 4. If it is really a standalone year, is it the case that the U.S. shareholder simply has the gross income inclusion in year 1, but it gets no credit? Because why? The foreign taxes are not paid or accrued in year 1. I don't personally read kind of a each year stands alone concept into the statute. It's telling you identify the property attributable to taxes. It's not going to be the case, I don't think, that the government is going to tell you you can accrue those taxes earlier. Instead, I think the approach is likely going to be a catch-up. So in year 2 and year 3, there's got to be some mechanism, if those are the years in which the foreign taxes are paid, to make the U.S. shareholder whole. Probably a couple of different options there. Perhaps you allow an amended return for the prior year to pick up those foreign taxes, or perhaps what I think is a more simple approach is simply to associate the foreign taxes, let's assume in the case of guilty, associate foreign taxes paid in any given year on tested gross income or on tested income, whether of that year or prior years, associate with guilty in that year. So just catch up in the current year as opposed to going back and amending returns. That, to me, I don't know what you guys think, seems to be the easiest approach.
Does it matter? Is it useful to think about why there's a difference and why you don't have the tax in a given year? It could be that just the local year is different from the U.S. tax year, so just a difference in local versus. It could be that it's part of an audit adjustment, and how you think about that probably informs, because presumably if it's an audit adjustment, you'll relate back the tax to the year of the income.
Right.
So,
question?
How do we treat that situation where we don't have the matching? So we have the 901, but we don't have the inclusion in that year. But then
Let me just ask one. Pam, should I be repeating questions if they're asked from the audience so people on the webinar can hear? Yeah, so no, great question, and thank you. And by the way, I was remiss in saying, you know, this is obviously an audience, as I look around and see a lot of familiar faces, that's not shy. Thank you for asking questions. Please do jump in at any point. It's a lot more interesting for us as well as you if we have questions. So the question was, is, you know, what Jose and Pat were just describing, is this similar to the way one might think about associating foreign taxes with a distribution of PTI? How do you think about, you know, that concept of sort of linking the tax to PTI, which is obviously income that was previously taxed? So how do we think about that?
I think that's a little bit different. So a PTI distribution directly into the U.S., that is still a credit allowed under Section 901, right? So 960 isn't relevant. Instead there, I think the question is into which foreign tax credit basket are those taxes placed? And then Michael will go through those issues, right? And so maybe there what's important is whether the PTI is 965 PTI, is it GILTI PTI, is it Subpart F income PTI? I think this issue is mainly where at the CFC level, right, it is paying the foreign taxes on year one income in year two or later, simply because there's a different local tax year end, or it's an IRS audit, their version of an IRS audit that is settled in a subsequent year. In that case, those taxes are paid at the CFC level. The only way to bring those to the U.S. is through 960. And so those taxes have to be properly attributable to some income. If they're paid in a subsequent year, they can't be picked up through the normal mechanism unless they tell us you can go back and amend. Now, in certain cases, 905C will force you to go back and amend, but only when its conditions are met. And so I think the question is, if 905C doesn't apply, am I allowed to go back and amend, or do I have to? Can they simply associate those taxes with the current year GILTI or Subpart F income or whatever the item of income is? There probably would be some splitter concerns that they'd have to work through, but that I think would be the easiest approach. So you'll have those types of questions, right?
Again, the question was, what if you don't have income in the second year, which is obviously, I think, the key point that the government is going to have to figure out what they're going to do with. I mean, I don't want to say solve for, because that implies they're going to always give you the credit. We hope they do. But Jose, go ahead.
No, it's a great question, right? So it's got to be then some hybrid approach, right? If there is income in that second year associated with that income, it's got to be associated with some income. Maybe it's third year income, fourth year income, but those taxes are certainly associated with GILTI. And so the question is, what type of mechanism then can be put in place to make the U.S. shareholder whole, right? It cannot, I don't think, be the case that the taxes simply disappear and are never allowed as a credit. But it is an incredibly complicated area. Just to pick up on Pat's point, right, perhaps some fact patterns may not be that sympathetic, where there is a difference between the U.S. year-end and the local year-end because of an election we've made in the U.S., an 898 election. Perhaps they wouldn't look, very sympathetic on that. But in other cases, the CFC may have a required local year-end that just doesn't coincide with the U.S. year-end. There's not much you can do about that, as well as you can't really control foreign audits. Those are going to settle, and you're going to have to pay tax when they're settled.
One solution I'm thinking of is, if you don't use your foreign source income in year one because you don't have any STCs in your 904 limitation, possibly a carry forward the next year of the previous year's foreign source income it didn't have taxes associated.
So the comment was one solution is perhaps a carry forward of the income in year one to the year in which the taxes are paid. As an inclusion or just as a limitation, I think you still need the mechanism to sweep the credits. You're saying sort of like a notional income amount that is there to sweep the credits in the subsequent year? I mean,
well, and remember, at least in the context of the GILTI basket, one thing we do know that Congress spoke pretty clearly on, that the GILTI basket has no carryover or carryback. So I think this is something that Treasury is going to have to figure out some way to solve for. I think what I think is interesting, and I mean, there are lots, obviously this is a fascinating area, and as Jose says, tons of unanswered questions, very complex. Just in listening to Jose describe kind of a mechanism that could work here, what I keep hearing are effectively quasi-902 concepts creeping back into the way the government may very well be thinking about this. That's hardly shocking when you think about the fact that people have gotten very comfortable with 902 concepts, recognizing that 902 pooling made a lot of sense because you had, as Pat Jackman described, issues with different year ends, you have timing differences, things like that. Pooling sort of solved for all of that in a way that was not perfect, to be sure, but dealt with a lot of those issues. The properly attributable standard, we don't know what it is exactly, but we do know that there's going to need to be some attempt on the part of the government to solve for these sorts of timing differences while recognizing that we don't have a carryover or carryback in the guilty basket. It simply doesn't exist. Yeah, Charles? So I'm gonna hold that because we are going to come back to treaties, I hope. But because I think we could spend 2 hours on treaties and not exhaust the material by any means that's there. It's such a great area, fascinating area. But if you don't mind, we'll come back to that. Yeah, thanks. Okay. Yes.
So the comment was, why don't you match up the accrual of the foreign taxes with the accrual of the income, and that will prevent this mismatch. I think it's a fair point. I think probably unlikely they can do that through regulations, but that would certainly be a solution. These 902 legacy issues about pooling, I think they continue to exist with respect to 956 inclusions for a couple of reasons. 956 inclusions still are going to be based on applicable earnings, which is still a pool of earnings, positive and negative amounts, and you'll have an inclusion potentially out of multiple years' earnings, and so you'll need to keep track of foreign taxes associated with E&P earned over multiple years. I think that's what the standard required. There has been some indication in the past that perhaps even for 956 inclusions, they would not look toward to prior years' foreign taxes, which I think is completely the wrong answer. Where the inclusion is out of prior year earnings, I don't see how anyone can say that foreign taxes paid in prior years are not properly attributable to that inclusion. Then the final comment I'll make then, question?
Last slide. The 956, which basket is that coming out of? Is there a determination where it's coming out of that 956 investment in U.S. property? Because we now apply that.
I think the legacy rule sort of kind of treating it as a dividend on a look-through basis to the earnings at the CFC level likely survives. So depending on where the earnings are at the CFC level, it won't be into guilty unless they decide tested income that's not included because of an offset by a tested loss is itself guilty. Otherwise, it will be with respect to untaxed E&P, which I would expect then to be in the general limitation basket. So the question was 956 inclusions, what basket do they go in? Likely the character of the earnings at the CFC level.
For the folks on the phone, I am to give the CLE code or on the webinar, which I have written down here, Pam, as 5681. Okay. So 5681 for those of you, the millions of people listening virtually.
And the last comment around this concept is a question of how precise do we think they're going to want to get in determining properly attributable to taxes. And so simple structure on the left, right? CFC Holdco owns 2 CFCs. This is a guilty example. CFC1 has tested income and has foreign taxes. CFC2 has a tested loss. It also paid foreign taxes. On the left side, the guilty inclusion, just ignoring QBI for a second, is 60, and the U.S. parent would claim 60% of the foreign taxes by CFC1. So no credit for the foreign taxes paid by CFC2 because it had a tested loss. What if you move to the right side, where now instead of regarded entities, the two are disregarded? Now you're doing a guilty calculation at the CFC Holdco level. It's got arguably tested income of 60, and it paid foreign taxes of 50. So now can you claim a credit for the entire 50 of taxes that were paid in the aggregate by CFC Holdco through the disregarded entities? I would say if you're looking at it at a sort of CFC level, yeah, those $50 in taxes are properly attributable to the 60. The question, though, is could they try and get a little bit more precise and say, no, 50 is not entirely attributable to the 60 because some portion of that was paid by an entity that on a standalone basis had a loss. I don't think that's the more natural reading of the statute, but certainly, as Pat said, they're going to have to define what properly attributable to means.
Well, thanks, Jose. And one of the things that I think is interesting about this slide, and Jose's slide is ambiguous on this question deliberately, but what if CFC1 and CFC2 or DRE1 and DRE2 are in different countries, so that the foreign taxes associated with CFC or DRE1 are paid to the UK and CFC2, DRE2 is in France. There is a certain awkwardness to saying that taxes paid in France are somehow associated with income when I think about the net positive income in this picture that was only earned in England or earned in the UK. That's not a natural reading necessarily to a layman of properly attributable to. You might say, well, wait a minute, if my net income amount was really only in the UK, how are my French taxes somehow getting pulled into that? I like the answer that Jose is suggesting in this fact pattern, and I hope that's where Treasury goes. But it is worth noting that it's certainly not one that sort of is compelled, and one can certainly see the counter argument.
Yeah, I guess the other thing is not only do we have properly attributable, but at least for 960A, you have item of income, which is even more precise, arguably.
Yeah, that's a great point, Pat. So the whole item of income, language is used in 960A, and that what's fascinating about that, of course, is we know that item of income. There's a history to that turn of phrase in the code and regulations, which doesn't literally mean item by item, but neither does it mean throw everything into a big basket either. So the government actually is not writing on a blank sheet of paper there and thinking about those sorts of concepts. So I think in the interest of time, we're gonna have to keep going. We are already up at slide 10, which means we're just stampeding through this stuff. And thanks everybody for the questions, and do keep them coming. So where's the? That's okay. So I just got I think one slide here. Guilty as not your father's FTC basket. I think the regime that existed prior to tax reform in the area of the foreign tax credit, and particularly as it related to the interaction between the baskets. Look, as I say, I wouldn't think people would describe it as elegant, but it worked. And I say it worked. That in general, what the rules relating to the interaction between the baskets generally offered is that over a multi-year period, they would present an accurate representation of a taxpayer's limitation across multiple baskets. So if you had a loss one year in one basket, a so-called separate limitation loss, that loss would get allocated across the other baskets, but it would be available in subsequent years to get recaptured. As Michael's going to demonstrate for us, guilty really, it's an overstatement, I guess, to say, but guilty really does violence to that logic and that symmetry, largely because it's written as a foreign tax credit basket. It is a foreign tax credit basket, but because of the lack of carryover and carryback, it doesn't operate like the other baskets, and so this interaction between the baskets points is really, frankly, thrown into a considerable amount of chaos as a result of this. So Michael's going to take us through that.
Sure, and one thing I'd add to all that is, of course, guilty not having carry forwards sort of cuts across what we've had since 1958 when we had the carry forward enacted for the first time. You can add to that, it came into existence at the exact same moment the branch basket came into existence. And so everything you might think of, well, whatever the old system is and how we move to the new system, we need a set of rules presumably consistent for new baskets, except that one of those new baskets has carryovers and one does not. And that really, I think, puts the government in a very interesting position about how do you think about these things, because they are really not the exact same kind of animal. So just there are a lot of numbers on these next couple of slides, and I don't want to spend a lot of time on the actual numbers, but just conceptually what's going on and is you have a company who has $500 of general income and has a $500 branch loss. And as a result of that, the separate loss limitation rules tell you in the same year, when you lose money in one basket and have income in another basket, that loss is going to jump over and reduce the income in the basket, in this case the general basket. But the good news is when that reverses and you have income in the loss basket in future years, it will get recaptured so that across multiple years you end up with the right amount of income in the general basket, right amount in the branch basket, et cetera. How does that work multi-year? First year, the $500 of loss wipes out the $500 of income. That is at least initially bad news because the 105 of taxes, which is 21% rate there, are completely not creditable. But of course, the following year, when the branch basket turns around and one has 500 of income, that 500 of income in the branch basket will get recaptured and treated as general income. As a result of that, when you look at the 2-year period, the general basket ends up with 500 of income, and those 105 of taxes in the first year are now fully creditable in the second year. And so this cross-year, the separate loss limitation rules that are applying cross-year works out just fine. Limitation shows up, and your credits are fully creditable. How does it work when you flip over and do the exact same thing with the GILTI basket where there is no carry forward? Again, here we have a $500 loss in the branch basket, but we have a $500 of income in the GILTI basket. And let's just assume that's after you do the $250 deduction, just for simplicity purposes. Year one, that 500 loss is going to wipe out all of your income in the GILTI basket. And so those same 105 of taxes that are in the GILTI basket on that 500 of income are not going to be creditable because we don't have any limitation. Year two comes along, and we have 500 of income in the branch basket. So the branch is reversed. We've got income. The separate loss limitation rules step in and tell us take that 500 of income that's in the branch basket and put it into GILTI. And you would think at that moment, just like with general, everything will work out. Now I have limitation in my basket. I'm going to claim those credits from the prior year, except that GILTI we don't have carry forwards. So what actually happens is in that first year where the loss in the branch basket wipes out your general limitation, those credits are not creditable and are lost forever. And then in the following year, when you actually have income in the branch basket that gets recharacterized as GILTI, and now you have your limitation available to claim the credits, one, the credits are gone, so you will never get those back. And theoretically, although this I think is largely theoretical because you will have other GILTI credits, if you don't have enough credits in the second year, well, you will have limitation there that you will never be able to use. And so across the 2 years in your GILTI basket, that limitation will disappear, the credits will disappear, and you end up being taxed on your GILTI basket, at least with respect to this piece, without any foreign tax credit. So why does this matter, or at least one big reason why this matters, is in the past, the branch basket did not exist, and it was just folded in with general and everything was together. Now that we've pulled those apart, it turns out branches stand alone. And typically people are in branches because they ran losses and they wanted those losses on their U.S. return immediately. When those losses got blended with income in general, nobody cared. But now we have branch baskets throwing off losses and creating separate loss limitations. And the last bit of good news is, of course, how do you fix it? Well, you just get rid of your branches, except that the way you get rid of a branch is you incorporate it. And as we know, incorporating a branch post-tax reform has become incredibly difficult to do in light of some changes to the 482 rules and 367.
What do you think the purpose of the branch rule is, and what were they really getting at?
The question is, what is the purpose of the branch rule? And I think it's really interesting. Historically, we knew and just to step back a little bit, we knew what the baskets were doing. They were largely trying to put income together with the credits that are related to and subdivide that so at least we weren't cross-crediting where we didn't want people to do. The new baskets that we have post-tax reform are not doing that at all, or at least that is only part of their function. And it's a very strange place to be. I don't think we've ever seen this. I mean, just as I've used this term before, the entire foreign tax credit system was designed to have branch sub parity. We invented the 902 credit back in 1921 so that subs were treated just like branches, and the general basket applied to active income, whether it was a branch or it was a CFC or earned directly. Now we've created branch sub disparity. And in fact, it matters completely whether I earn the income from those same activities in a branch, in a CFC, or somehow directly on the U.S. tax return. And that is a completely novel concept. And I think part of where it's going to your question, Peter, is the branch basket isn't doing anything that baskets have historically done. It's about, in many ways, I suspect, discouraging people from using branches because they didn't put branches into the quasi-territorial, or what I refer to as worldwide territorial system, which is just worldwide taxation. They didn't put them into that system. They didn't get the benefit, and they needed to do something to disadvantage them. So people didn't play the game of put your losses in the U.S. put the income in GILTI, put your losses, leave those in branches, or if you have really high taxed income, put those into a branch as well because you want to use the credits. But we're doing different things.
Paul had a quick question, and then I think we're going to need to move on. But go ahead, Paul.
I agree with what Michael was saying. I think, the folks who were thinking of having a branch basket were thinking of it in the days when royalties and interest were going to be in the general limitation basket, and if you didn't have a branch basket, you could subsidize them. If those royalties and interest are in the GILTI basket, then a lot of the rationale for the branch basket goes away because you don't have any general limitation. But one question for you on the separate limitation laws. I made the argument that Treasury did, if you guys think there's any merit to it. They have regulatory authority to at least stack last and maybe not stack at all separate limitation losses. And they don't have authority with overall losses because that's basically but the statutory provision on separate limitation losses is pretty general. And I doubt that they'll take us up on that, but it seems to me that they have some authority to help try to solve it. Just to repeat the question and to repeat the first comment was Paul agreed with me, so I want that on the record. But the question was, do they have regulatory authority to fix some of this problem? We'll come to overall domestic losses just very, very quickly. And, for example, allocate the separate loss limitation first to general and not to GILTI and therefore at least minimize the effect of this. I think it's actually harder in the separate loss limitation context than, for example, the overall domestic loss context. But hopefully it's something that they will seriously consider. The statute, and the reason why I say that, at least on the separate loss limitation, it talks about the SLL being allocated ratably to the baskets. When you get to overall domestic losses, which, again, let's touch on briefly, there is no statutory rule about what you do with an overall domestic loss, even though it has the exact same thing. There's just regulatory guidance where they allocated it ratably. And I think that made complete sense when all the baskets were the same. And now that they're not the same, it would make a lot of sense if they took some of the pressure off.
Yeah, of course, implicit in all of this, and Paul, your question really highlighted it, is, how willing is Treasury going to be to try and, deal with some of these issues that do arise, I think largely because of the unequal treatment of GILTI as a foreign tax credit basket. It's interesting, one of the solutions that people have proffered for that is, well, really just you should fix GILTI so that it has a carry forward and a carry back just like the other baskets. I would submit, at least from the perspective of multinational companies, I actually don't think that's the right answer. Because I think the reason that GILTI had no carry forward or carry back is because they were really trying to create something different, which is a minimum tax, and jammed it into the foreign tax credit regime. And the way to make it work as a minimum tax was to say, well, it's just a standalone snapshot 1 year, and you don't get a carry forward or carry back. That was the way to breathe life into that concept. Of course, they brought in a lot of other concepts along with that, expense allocation and things like that. I would say the much better answer would simply be to pull GILTI out of the foreign tax credit regime entirely, do a standalone minimum tax calculation, which is frankly what we all thought we were getting. So that's my editorializing there. I will also say just quickly on Peter's question about the branch basket, we could spend hours on the branch basket just by itself. There are so many issues in the branch basket in terms of how do you figure out what income goes in the branch basket when you have things like disregarded payments between a branch and a home office. There is just a plethora of issues that Treasury is going to have to figure out on that, and there's really no script to write on there either as well. So I know we got to move on. So Michael, if you can really quickly hit ODL.
Yeah, ODLs are the same concept. Instead of a loss in a basket, you've got a loss on your U.S. source income. So the same strange mismatch where you lose credits in the first year and then maybe get limitation you can't take advantage of is happening, and so you're paying tax on some portion of your GILTI without any credits. The added bonus is, of course, the 250 deduction that is out there is limited to taxable income. And when you run an overall domestic loss that starts to cut into your taxable income limitation, you now will be paying tax to that extent potentially without foreign tax credits and at the full 21% rate as opposed to 10.5%. And so overall domestic losses are particularly hard. Unlike incorporating a branch, not losing money is even harder to avoid. Something to think about. Anyway.
Thanks, Michael. So Jose and Pat are now going to take us through the continuing relevance of expense allocation, a sad topic, but one that we nevertheless need to cover.
It is very sad. So why is it relevant? Well, because not a lot changed, right? They just made the system more complicated. So it's still relevant, obviously, for determining your foreign tax credit limitations each year, including for the new GILTI basket that Michael just mentioned. At the CFC level, you still have to calculate Subpart F income, so you need to allocate and apportion expenses. You also, though, now need to calculate tested income, tested losses at a CFC level. And then back at the U.S. level, the foreign-derived intangible income deduction requires an allocation of expenses against eligible income. Turning quickly then to the basic principles of expense allocation and apportionment, they've not yet changed. I think this is an area that the Treasury Department is actively working on. I heard a couple days ago that we might expect revised regulations in this area by the end of 2018, possibly not with the GILTI regs that are expected earlier than that, but they are actively working on it. So the slide just lists all of the relevant rules in the regulation that, as I mentioned, have yet to be updated. Most of the attention to date as it relates to GILTI has been on interest expense apportionment. That's really caused a lot of the problems, so we didn't think we'd sort of cover those items again. Instead, we thought, hey, let's focus on the R&D expense apportionment regulations, because in many cases they can create the same, maybe not to the same extent, but similar problems as interest apportionment. Sort of broadly speaking, R&D deductions are considered to be related to all income reasonably connected to the relevant, very broad product category for which the IP is relevant, and as a result, the expense is allocated to all gross income in that class. Broadly, it's based on SIC codes. That's how you identify the product categories, and for this purpose, an affiliated group is treated as a single corporation. If you go to the regulations, there are two special rules: legally mandated R&D, specifically allocated to the geographic location where that requirement exists. There's a separate special sort of exclusive geographic apportionment rule depending on if certain level of activities are located in a particular location, and then the remainder is apportioned based on either the sales method or the gross income method, and that is really where most of the focus is and has been. At a high level, the sales method requires you to identify all of the sales associated with the relevant product category, both in the U.S. and outside of the U.S., certainly from related parties, in certain cases from unrelated parties, and apportion that remainder of the R&D expense in that manner. Some of the open questions that have been asked are, I'm looking at this to determine how much of this expense is apportioned to the GILTI basket. If I look at a CFC level and identify that sales in my CFCs, is it the case that sales and the income from the sales at the CFC level generate GILTI? So is GILTI a CFC level concept? I think the government has been fairly clear that no, CFCs don't have GILTI. GILTI is a U.S. shareholder level concept. When everything comes together, the item is at the U.S. level. So is it the case then that CFCs don't have GILTI? I think the answer is technically yes. That probably, though, doesn't answer this question. I would expect the way they're looking at this is, look, at a CFC level, there's two ways to look at it. GILTI can be treated like Subpart F income because it's determined effectively at that level, and so therefore CFCs have GILTI for this purpose, and so their sales generate GILTI. Or you just say, no, at the CFC level, the GILTI is really the tested income, and so a CFC that has tested income has GILTI, and therefore if sales are generating ultimately tested income, then that's relevant for apportioning R&D expense at the U.S. level based on the sales method. That does require, I think, an update to the regulations, but it is what I would expect. If you're instead using gross income, the gross income method, the question's a little bit different because now you're looking at income in the U.S. What's the income on my U.S. return? Well, you're obviously going to have GILTI, and you'll have Subpart F general limitation, from branch basket as well. The question, though, is what if I have royalties? If I'm receiving royalties from my CFC, where are those royalties? Paul said we probably can expect them to go into the GILTI basket, and I think that's what most people anticipate. And so royalties are in GILTI. They're only going to increase the amount of the R&D expense that's apportioned to the GILTI basket, making the result that Michael just walked through worse. Some are questioning, though, whether that is the sort of appropriate result, but because at the CFC level there's already royalty expense. And if you're then duplicating that by apportioning more R&D expense in the U.S., are you not duplicating the allocation of expenses from the R&D to the GILTI basket, which seems to be the wrong result? Again, I think requiring an update to the regulations.
You can say something. Go ahead.
One comment on that. There's been a historic kind of mismatch. I always call it two ships passing in the night between the R&D reg, which looks to foreign sales and domestic sales, and the post-SDI treatment of royalties that back in the United States. And wonder whether when they revise these regs, they're going to get into the whole issue. Heard anything about that? There are domestic sales for R&D apportionment purposes under the sales method at least that are generating foreign source royalties that would be in the GILTI. That seems to be an anomaly that we benefited from for the last 20 years. I just don't know. I know they're aware of it. I just don't know whether
The comment, I think, is there are issues with the regulations generally, not created solely because of reform, and whether as they revisit these, are they going to take on those additional issues? And I think it stems from the fact that they seem to understand that R&D ought to be allocated to royalties and not just to GILTI income, if the GILTI income isn't related to royalties, which is right. Now that nobody can do a tax-free transfer of IP offshore, it could be allocated to R&D royalties and not anything else. Well, then that's what focuses the question of, well, some of those royalties are foreign source, even though sales are respective. So will they take on those issues? Last I had a conversation with them, it seemed to me that they were going to take a sort of more comprehensive approach to these regulations and take on those legacy issues. Question now, I think, is going to be timing. Do they have enough time to do that before year end? Because I do think in this area, generally, as it relates to guidance, they're probably looking to beat the June 2019 deadline so they can make a lot of these rules retroactively effective. That ultimately, I think, will be the question.
Yeah, I would agree. I mean, I think implicit in a lot of this stuff as we keep talking about, the consistent theme across everyone's comments, of course, is, we need guidance from Treasury, we need guidance from Treasury. The questions that very small group of really talented tax professionals in the Treasury Department and Office of Tax Policy are going to have to answer that's a daunting list, to put it mildly, and I obviously think they're going to have to prioritize. Paul's question is a great one. As you point out, though, Paul, this is an issue that's been around for 20-plus years. And so query whether they will say, well, as long as we're looking, let's throw all these things in together, or whether they will have to stratify these in some way and decide to come back to them. We obviously don't know the answer to that.
I was going to say, to some extent, obviously, the numbers would be much smaller, but you could have had situations pre-reform where you had Subpart F income instead of, GILTI income, in which you have to deal with similar issues where you've got Subpart F income coming in terms of what's part of your gross income base. But
okay, so I think we're going to do 904B4 now. Pat, that's
right.
Great.
Sure. So we kind of lied, or someone here lied, in that we're not going to talk about interest expense allocation because we have to talk about it a little bit if we're going to talk about 904B4. So 904B4 is kind of the companion provision with 245 Cap A, and so it's dealing with the fact that we've got some income, maybe not a lot of income, that is entitled to 100% DRD, and to the extent that we've got expenses, in particular interest expense, that under allocation and apportionment rules is being allocated against that income, kind of what do we do with it? And so the approach that was taken was 904B4, which originally was 904B5, and sort of the income side makes a lot of sense. So the income that from the dividend that qualifies for the 100% DRD, you take out the income for foreign tax credit purposes. Likewise, the DRD, the 100% DRD, you eliminate that deduction. So that makes sense. You would have expected 0 on the dividend side. But what do I do on the expense side? So the language is to try to figure out what portion, because most of the issue is allocating interest expense based on stock in a CFC. And so how am I going to figure out what portion of my interest expense in the U.S. is allocable to the portion of stock that's giving rise to exempt earnings? And so in terms of the approach there are many issues like that sort of permeate thinking about GILTI and 904B4, which is when I'm trying to figure out the character of the stock, our current interest expense rules would say what type of gross income does the CFC throw off? And so back to this question about what type of gross income does the CFC throw off? General, passive, and now I'm trying to figure out these exempt earnings. Do I do that based on an actual dividend coming back to the U.S. when I in fact know whether there's a 245 Cap A dividend associated with the stock? Or do I simply say, look, any earnings that are in the CFC that haven't been picked up as regular Subpart F or GILTI, that portion, those kind of earnings will be relevant for characterizing the stock, and which ultimately would be relevant for how much interest expense gets allocated to 904B4. Bunch of questions there. As I said, you look to gross income. If I'm going to look to taking into account GILTI, that's a net concept. GILTI is at a shareholder level versus a CFC. So lots of questions about how, in fact, I figure out how much interest expense is allocated to the portion of stock related to exempt earnings. But let me just illustrate something that reflects that it's not just something that impacts exempt earnings. The approach for how expenses are dealt with on exempt earnings can impact the limitation in other baskets. And the reason why it impacts the limitation in other baskets is, and just to review our formula for thinking about, I think we have our formula up there. So our formula for figuring out how much limitation I have for a particular basket, kind of the longhand formula is foreign source income in the basket over worldwide taxable income, and then I try to, that's going to tell me what portion of the U.S. tax I'm incurring that is viewed as relating to that foreign source income in that basket. That's what the fraction is trying to do. And we used to have kind of our shorthand was, well, let's just figure out what my foreign source income is in the basket and multiply that by the applicable U.S. rate. Well, now we can't adopt that shorthand formula because the expenses that are viewed as allocable to exempt earnings, so again under 904B4, not only do they not create additional limitation and general limitation or some separate basket, but they impact the denominator in that foreign tax credit calculation. So what you'll see on the slides is that my fraction now rather than just being foreign source income over worldwide taxable income, now it's foreign source income over adjusted worldwide taxable income. So to the extent that I've got expenses that have been allocable to exempt earnings, those expenses are taken out of the worldwide taxable income, so I'm adding them back, if you will. I guess in the interest of time, we do have, or I have, a couple of slides here that are illustrating what happens with interest expense allocation. And what the example is trying to do is, what is my foreign tax credit limitation in the GILTI basket? And there have been many panels that have focused on the fact that, and this example doesn't actually show the amount of taxes that were associated with the GILTI inclusion, but people are familiar with the fact I've got a 20% haircut. I may have interest expenses that have been allocable against the GILTI basket that will create a limitation in my GILTI basket, just interest expenses against GILTI. Well, this rule in 904B4, which is impacting the denominator, is going to impact the amount of limitation that I have in the GILTI basket. Because rather than just taking 21% of whatever my GILTI basket income is, now I'm actually taking my GILTI income over adjusted worldwide taxable income, which is now a greater number. So my portion of my fraction has gone down for purposes of figuring out what credit I can have against GILTI income. So that was the main point on 904B4. One just nugget that I will leave with you is that despite the heading which focuses on Section 245 Cap A DRDs, if you focus on what income is excluded, it doesn't focus on the fact that there has to be a 245 Cap A. So if you had a hybrid dividend, for example, it seems that based on the statute, you would actually eliminate the hybrid dividend, and the hybrid dividend would also be, in this case, favorable because you would actually reduce your adjusted worldwide taxable income. At least that's my kind of read of the fact that 904B4 is not conditioned on the relevant dividend qualifying for 100% DRD.
Just to step back, this only applies to the few companies that don't fall under GILTI, right? Like this is just for companies that are not GILTI but have participation.
Yeah, this is presuming that those companies that are subject to GILTI will have, some Q-buy return, so they'll have some amount of their tested income that isn't being included under GILTI, and so that is the small category of the exempt earnings that would qualify for the 100% DRD.
Though I would dispute that that's a few companies. It's not a few companies, I think. There's a large number of companies who are going to have some element of Q-buy.
Oh, yeah, lots of companies.
To be sure. Yeah, it's just the question is how much. Thanks. I think we're going to move on in the interest of time and let Michael talk about PTI. I think Pat, stated this point quite clearly, but just to reemphasize it, the more time I have spent in 904B4 and doing these calculations, the more surprises I find. It is not an intuitive exercise, or it's just algebra. But obviously, funny thing happens when you change numerators and denominators. Sometimes weird things come out. And so, I think Pat's example highlights that quite well. But it is worth spending time in the details, the bowels of these calculations, because sometimes it's pretty surprising what you think you want. Turns out you turn the sausage grinder and you come out the other. Actually, no, that was a worse answer than I thought I had before. So worth spending some time with. So, Michael, we're going to talk now about PTI.
Sure, and I will just high level, right? The old world, before we had tax reform, most of our earnings were deferred. They were trapped for many companies. There was a little bit of PTI because everyone had structured to get rid of their Subpart F income, and it was very easy to bring what little bit was home. In fact, it was the one thing that people repatriated kind of on a current basis. Now, post-tax reform, we're in the new world, and lockout is gone, which is great news, although now it's gone in part because everything is PTI. And if it's not PTI, there's also going to be some small part of which is exempt. The very strange thing is, as easy as PTI was to bring home in the old days, it's turned out it's become very, very hard to do just at a time when we have an awful lot of it. and it also turns out that we really need to get this stuff home. And there are a couple of reasons why you need to do it. One is everyone told their Treasury departments that we could bring back all of our money, and so they spent that money 6 months ago, and now people are being expected to fill the checking account, as it were.
Not an exaggeration, by the way.
No. Might be, some people might be 9 months, maybe it's 5 months, but it's in that range. The second thing is, of course, it's assets offshore. And as long as you have earnings offshore, you have more value, more stock basis in your CFCs, and that means more expense allocation, especially with respect to interest. So getting this out is helping solve your interest allocation, which becomes critical. When the world had very little PTI, we didn't care about some of these issues. Now we have a ton of it, and we have all these rules, many of which were enacted in 1962, largely unchanged, regs from the mid-1960s, and we're going to be putting an enormous amount of pressure on those rules, whether it's the 959 PTI rules, the rules about foreign tax credits on PTI, and basis. So, again, why is repatriation important? You know, getting cash back and expense allocation. Ironically, PTI is not taxable income, so what tax issues could there be? I think the two big ones are, one, foreign taxes are going to be accrued as that PTI works its way back to the U.S., whether the withholding taxes, higher level income taxes, you've got a lower tier CFC. What happens to those credits is very important. Another big issue is going to be foreign currency gain and loss on the PTI. We're not going to cover that, but that isn't because it's not extremely important. So what are the big foreign tax credit issues when you think about PTI? One is the amount of foreign tax credits that are going to be associated with your PTI. And one is a big question that gets at what Jose was already talking about. How do we figure out when taxes are related to the PTI? And so there's a big issue that's floating around there. Two, there are a lot of places where we may have haircuts to the tax credit. As we know, in repatriation, the earnings came home, but came home with a very significant deduction to get to the tax rates we have. So you could think of that as 40, 50, 60, 70% of the income being exempt. And, of course, there we got rid of 40, 50, 60, whatever percent of the foreign tax credits. Well, now when I bring that PTI home, if I pick up some more taxes along the way, are the taxes on the PTI going to be haircut in the same way the taxes on the underlying earnings were haircut? Or will we get to take a full dollar-for-dollar credit for them?
Michael, on that point, the 965 PTI is not all 2017 or 2018 PTI. Like, it goes back all the way to 1987 because that's when the CFC earned the E&P, even though the inclusion was in the earlier year. So keeping track of that separate from your actual Subpart F PTI, from the GILTI that you're layering on top of it, just makes this even more complicated.
I think that's right. I mean, ironically, going back to something Patrick said before, we got rid of pooling. I think the sense was getting rid of pooling was simplifying the system, and I think the simple answer is maybe people forgot that the whole reason we had pooling was to simplify the system. And it turns out it's right, because when you get rid of pooling, it isn't simple. But so the next question is, if we've got these taxes, we have to figure out what basket they go into. Once we figure out what basket, we need foreign tax credit limitation in order to claim those taxes, and we'll talk a little bit about 960C, which is the backwater of foreign tax credit, which nobody has ever thought about or read about, but has now become incredibly important and also is potentially incredibly powerful. And then last of all, ordering rules. We've had PTI ordering rules, quite frankly, in the statute and regulations for a very long time. We'll come around to where that matters because you can pay out different layers of PTI effectively, and if you think you have different types of PTI, what's coming home may actually produce different results.
So, Michael, sorry to interrupt. Just a time check here. It is 9:40. The CLE code is 4554. 4554. And now I'll turn it back over to you, Michael.
Okay. So why do we have different types of PTI? And this is just a very simple example we want to touch on. You have a U.S. parent. It has two CFCs, and this is a 965 example. One CFC has 100 of earnings and 50 of taxes. The other CFC has 20 of deficit and 5 of taxes. The very good news was that the way the rules were written, that $20 deficit for repatriation gets to offset the 100 of E&P. So what are we left with? Well, one, we have this category of PTI, the 80 that's sitting in CFC1 that we pick up at 965. And that's the part where, although we pick it up in the U.S. tax system, we get a credit for it. We get a rateable credit based on the amount of deduction that we got with respect to that income. Then, while we picked up 80, we've got this other category of PTI, which is the extra 20 that's sitting there in CFC1 that did not get picked up. And someone had the wisdom to realize, well, we have 20 of earnings sitting off there. What do we need to do with it? And the answer is we don't want to tax it, so what do? We'll flip it into PTI, which is probably the right answer, but definitely an answer, and it has a lot of ripple effects. And I say that because we're going to get to one that is not necessarily the right answer. And then the third category that's sitting out there is CFC2, which had this deficit. And when someone had the wisdom to look at that and be like, well, if I turn the 20 that was offset by the deficit into PTI, well, I should get rid of the deficit. And how do I get rid of the deficit? They're like, well, we'll put some earnings into that company to get rid of that deficit. And so they wrote a rule that just basically adds earnings, or what I would call phantom earnings. One might say no harm, no foul. These are earnings that are going to come back. They'll come back as exempt effectively under 245 Cap A. That's good news, except that it turns out in this world, before this happened, we had 100 of earnings. After this happens, we have 120 of earnings. And why does it matter? Well, expense allocation. Like now we're allocating more expenses, and best of all, we're allocating to earnings which do not exist. And more troubling, since they do not exist, they might be harder to distribute back to the United States. So it's just something to be mindful of for people who have a lot of earnings. The government's aware of this problem. Hopefully they'll come up and solve this problem. But until it's out there, it's a piece that needs to be considered. So 960B taxes are, once we've got all this PTI out in the world, we're going to bring it home. And maybe we'll have a withholding tax. Maybe we'll have an income tax because it'll be a lower tier CFC that gets paid up. 960B helpfully lets us get a credit on that. And again, it introduces this concept of whatever taxes are attributable to PTI, which is more to come on that. It's also worth noting, and this is something just to put out there, a lot of what 960C is getting is lower tier taxes when it comes up. Of course, when that stuff actually comes out the top as a first tier CFC's distribution of PTI to the U.S., you're not in 960. It's not a 960C tax. It's just a 901 tax. You're a U.S. person. You got something and you pay tax on it. And that becomes important because there are slightly different rules, but effectively all those taxes are going to be creditable. As we mentioned, possible haircuts, 965 is one that's out there. Another question is this deficit offset PTI. I have this PTI. I never paid tax on it because it was offset by a deficit. What happens if there are taxes related to that PTI and comes back? Do we get the taxes? Do we think because it was never subject to tax you don't get any taxes? Is there some middle ground there? And then, of course, another category that's out there is GILTI, where, as we know, when you earn GILTI, you have a 20% haircut. You only get 80% of your foreign tax credits. Well, when GILTI PTI comes home, are we going to haircut that as well, too? I think the answer to that as a technical matter is probably no, and we'll see what the government does, because the 80% haircut is different than 965. 965 is if you have taxes that are with respect to your repatriated earnings, you haircut them. The 960 rule for GILTI is when you have a deemed paid credit on your GILTI, that deemed paid credit is 80%. If it isn't a deemed paid credit as a result of 960D, then I don't think you have a haircut, which means if that's right, we do really have different categories of PTI with different potential haircuts applying to them. The last question is basketing, and this is pretty straightforward, I think, although there's been some stuff that throws us into a little bit of doubt. If you have GILTI PTI, when the taxes are added to GILTI on the way up, it should go in the GILTI basket. Same for general, same for passive. But there is some stuff out there. There's an article that suggests maybe that's really more in the nature of a base difference. I don't have any income when I get PTI. Maybe the tax should be treated as a, quote, base differences, which is a tax for which there's no associated income. If we end up with that, it would effectively go to general or possibly to the branch basket because of a statutory glitch. I think the right answer is PTI will get tracked to the right place, and it will go into the basket of the original inclusion. But again, something we'll see more on from the government hopefully soon.
So, Michael, in the interest of time, because we are going to run out of time here, I think it's important to touch on 960C. That was obviously something that we touched on a little bit earlier, and we promised to come back to. So I think we can just hit that quickly, and then we'll shift to the look-through rules.
Yeah. And 960C is interesting. It's a rule that basically said if when you pick up your Subpart F income, you had some extra limitation. In the old days, maybe the Subpart F was taxed at 20%, so when you brought it home, you would have an extra 15% of capacity that was out there. And the rules recognized this, and they said, well, look, when the CFC pays back that PTI, if you've got that extra 15 of limitation will reappear, and it'll allow it so that the taxes on the PTI will be creditable because, of course, when the PTI comes back, I've got no income. That used to be a very narrow rule that was like by CFC, by category, by year. They changed that rule back when it didn't matter very much because there wasn't much PTI, and now it's like it's just basket by basket, which is, quite frankly, probably the right answer. It is also an administrable answer because tracking this stuff was impossible, but it does mean in all the baskets, including the GILTI basket, you've got this extra limitation that is floating out there that is going to transfer across years. And interestingly, someone's comment earlier about, well, if you can't carry forward the credits, can you fix this by carrying forward the income because there's no limitation on that? Well, it turns out that's what 960C is doing. It is effectively carrying forward that income to future years and can be used without any, there's no 10-year limit or anything on it, assuming you're not in excess credits in the GILTI basket. And so this is a place where I think a lot of people are going to be focusing and will become really important on a going forward basis.
So thanks, Michael. Look, there's a lot of stuff in here that Michael didn't even have a chance to get to on PTI. The slides are really terrific, and it's not hard to walk through them. And so just obviously in the interest of time, we do want to turn to the look-through rules, which I think Pat is going to take the lead on. Did I remember that correctly?
Oh, you did.
Okay, good.
But the question that people will probably want to ask, I have no answer for. Maybe you guys have the answer, which is there's been some talk about whether the look-through rules, which we'll get into a bit to understand the context, but whether the look-through rules will provide sort of looking through in a way that will produce GILTI income for related party payments paid by a CFC back to the U.S. And there has been a lot of talk that there will be look-through rules. I will say that having tried to work through some fairly simple examples, I think there are a lot of questions about exactly how they might operate, given that I've got some tested income that may not be included as GILTI. But just quick context, in terms of, why do we have look-through rules? I think we've talked about this a few times, different context, which is there's an attempt to have some parity between foreign branch and CFC. And at least one aspect of the look-through rules is to the extent that a CFC is earning the money, but then making a payment back to the U.S., that when the U.S. receives, for example, that interest income, if you don't look through to what the CFC has earned and characterize the interest income as, say, passive income, that would be distortive relative to having that income just earned directly by the branch, where you didn't have the related party payment in place. So that's clearly one aspect of why there are look-through rules. Another aspect, though, is going back to a notion that and look-through is generally helpful, has been helpful to produce as much sort of consistency between what the CFC is earning and what the U.S. is receiving, and generally having that as be general limitation income. Likewise, why people are so focused on GILTI is people are expecting to be limitation constrained for GILTI, so the more GILTI income that is created, including through look-through payments, the better. But the other policy reason referenced was it's encouraging eroding the local tax base. And people arguably are more inclined to erode the local tax base if they'll get a favorable basketing. So in terms of just the real basics, so when a CFC pays interest to its U.S. shareholder, to the extent rents and royalties, and in the old world, dividends mattered a lot. In the new world, Subpart F and GILTI inclusions will matter. In looking at interest, rents, and royalties, essentially the look-through rules will look to how the CFC has allocated and apportioned that expense. So If the CFC has, for the most part, just general and passive income, the recipient of the interest income will basket that based on how the interest expense has been allocated and apportioned by the CFC. Rent royalties question. Oh, sorry. Am I going there? Yeah. Okay. So just sort of covering a few things on the look-through rules in terms of what payments they apply to, and what I had jumped into is just how the rules apply to sort of different categories of income. And so on the interest, rents, and royalties, you look to how the CFC would have allocated the expense. For Subpart F inclusions, you look at kind of a pro rata share of earnings and profits. For a guilty inclusion, and this is where the sort of the question arises, probably people have heard many times that CFCs do not generate guilty, and so typically a guilty inclusion, absent the regs going a different direction, would provide that the guilty inclusion is likely to be general limitation income coming back to the U.S. rather than guilty income. One question in the context of partnerships. So one might say, why do I even need look-through rules for partnerships? Partnerships sort of by their very nature are look-through, or partners get their distributive share. But that aspect of look-through is focused on, of course, the income that the partnership has, that the partners have their particular share of, that just sort of flows through, if you will, the partnership. What happens in cases when there is a payment by the partnership to the partner? So payments that are not part of the partner relationship, non-partner payments, which could be interest expense, as a for example. Well, the CFC look-through rules have been extended to partnerships, and these sorts of payments, there is a flavor of an entity approach for these sorts of payments for a partnership, meaning I will look at the partnership and as kind of an entity, I won't look to how the partners are deducting that expense. I'll look at the partner level, and the interest income received by the partner, again, acting in their non-partner capacity, could be viewed as general limitation income, foreign source income in its entirety, even though the U.S. partners could be deducting that against their U.S. source income. So that's kind of how the rules have been extended to partnerships. One question, and we'll probably leave it here to move on to other things, is what about situations when the partnership is earning branch income? Now I've got this kind of basket of income that can be earned directly by the branch. When I think about look-through, does that look-through on this payment made by the partnership, we know that if the partnership's got branch income, that's just going to flow through to the partners. But what about a payment by the partnership to the partner in the non-partner capacity? Does that get basketed as branch income? Another situation is when the U.S. partnership, let's say we've got a U.S. partnership that owns CFCs. If the U.S. partnership is including guilty income, even though that guilty income is passing through to the partners because the Subpart F and therefore the guilty rules have an entity approach to partnerships, a U.S. partnership would be viewed as the U.S. shareholder. And so the question arises, what happens when a U.S. partnership makes an interest payment to its partner? Does that somehow, in the hands of the recipient, is that guilty income?
Thanks, Pat. Obviously, another area where we could spend a lot more time. I think in the interest of time, I will just quickly say a couple of sentences. You guys can jump in, obviously, on carryover of attributes, and then we'll finish off with treaties, which I think Michael is going to take the lead on. So, and cognizant of Charles's earlier question. We want to make sure we get back to that. Treatment of carry forwards. We describe on this slide treatment of FTC carry forwards. It's really not just FTC carry forwards. It's what you do with all, I would say, relevant pre-reform attributes, which could include, for example, things like overall domestic losses or separate limitation losses. Remember, you're moving from a world where you had 2 baskets plus whatever relevant treaty baskets you have to a world where you have multiple baskets. It may very well be that you had income, you might have had a loss, for example, an overall domestic loss in prior years that reduced general limitation income, but in the new world, you'd really like to have that limitation show up in the branch basket or in the GILTI basket. You may have foreign tax credit carry forwards that at the time were in the general basket, but going forward, you expect most of your limitations going to be in the branch basket, so you'd really like to have those carry forwards in the branch basket. These are all questions the government's going to have to grapple with. Won't probably shock anyone in the room to know that amongst my friends in the multinational community, people tend to express very strong opinions on what the right answer here is, based entirely on their particular facts, not based on adherence to some sort of strict underlying policy. I'm guilty as charged on that myself, I will say, so I don't mean to cast aspersions. But in any event, that's a whole set of issues that we have to add to Paul's list of the things the Treasury has to grapple with in the time available to it. So we'll finish, I think, again, with the time available to us with just a brief mention on treaties, which I have tangentially teed up as does anybody care about treaties anymore? And I hope the answer in this room is yes. I know it is for the people up here on the panel. So, Michael, take it away.
Yeah, I think treaties are one of those third or fourth order kind of questions that we're going to start to hear more and more about. There are a lot of things there, but one very straightforward one that was worth mentioning that ties to the foreign tax credit is, do our treaties change any of the answers that we received under this tax reform legislation? And why would they change anything? Well, one big place is whether or not we should be entitled to a full foreign tax credit. All of our treaties have what used to mirror U.S. law, which was that you were entitled to a tax credit for taxes paid to the treaty partner, and you were entitled to a 902 credit if you got a dividend on the underlying taxes of your subsidiaries. That rule was largely dead letter because domestic law already provided that, raising what I think is an important question: what was that language there for in the first place? And one might say the only thing it could have done is guarantee that to our treaty partners, hey, one day if the law changes, you will still be entitled to get a credit for taxes that your taxpayers pay to my country. So they'll still have an incentive to invest in the UK or wherever it might be. Well, it turns out no one ever thought that day would come, but we're here. So where do we go with that? And the answer, one other big question is, what's the interaction between treaties as a general matter and this new legislation? And there are a lot of interesting questions there. I think the general rule is they have the same status. Treaties can override domestic law can override treaties. I think there's a lot of case law, including the Supreme Court level, that would suggest that, notwithstanding that usually you will disfavor an override, so something later in time won't override something earlier unless there's a pretty clear direction that should have occurred. The one thing we do know is that the Joint Committee has said they didn't think this was an override. How broad or whatever is unclear, although the one thing that it does not say anywhere in legislative history that this was intended as a treaty override. More there. And to me, one of the more fascinating aspects of this is this parity between U.S. law and treaty law is also captured in the code in Section 7852D, which has a very interesting history and stuff like that. But what's kind of noteworthy about it, just something I read recently, was like, what does 7852 have to do with anything? There's a supremacy clause in the Constitution that provides for this, which has then been discussed and opined on by the Supreme Court. I'm not really clear Congress can change or do anything with the Constitution itself. So there are a lot of interesting questions. Why does it all matter? And and how far can this go? Well, it turns out we started disallowing credits now, right? We have this 20% haircut that's out there for GILTI inclusions. We have the haircut that we have for the 965. Although there, at least, I think there's some logic. If we're only going to tax half the income, you only get half the credits. That feels a little more unassailable. The 20% haircut on GILTI feels different. And for those of us who've waded deep into the waters of BEAT, the 100% disallowance feels moderately at odds with our treaties. And without getting into it, I would just, the next slide has the language, and people always say, well, look, the treaties have this stuff about, domestic law limitations, and that's where this all fits into. And we do, and we have a foreign tax credit limitation and all kinds of rules like foreign tax credit splitter rules and disallowances under 901K if you don't have a sufficient holding period. But when you read the actual language of the treaty, and we have the model treaty, it's, in accordance with the provisions and subject to the limitations of the laws of the United States, as it may be amended from time to time. Great news. They anticipated this legislation. Without changing the general principle hereof. And I don't know what it means to change the general principle hereof, but it seems like going from 100% to 80 might raise a real question. 100 to 0 feels like a pretty legitimate legal issue to consider.
So thanks, Michael. We'll leave it there. I just have to add, in closing this session off, as a alum of the Treasury Department, I had the privilege of sitting across the table from treaty partners back in the day that many of us will recall, when we not only had an alternative minimum tax, but there was a 90% limit under the alternative minimum tax. Effectively, you could only claim 90% of your foreign tax credits.
Treaty program.
Right. Well, actually, we had a functioning treaty program then as well. And being berated by a treaty partner because the 90% limitation, in their view, was very clearly an override of the treaty and very clearly inappropriate. Of course, we know Congress subsequently amended the code to get rid of that limitation under the alternative minimum tax. But back to Michael's point, it's worth noting that if taking away effectively 10% of your credits under the AMT is viewed was viewed by our treaty partners as a treaty override, I wonder how they're going to react when they sink their teeth into the beat and start to understand it. We will see. It's an open question, obviously, but if I were in their shoes, I know what I would be saying. So, look, the most pleasant part of all of this is now falls to me, which is to thank our panelists. This is obviously a terrific discussion. I hope you guys have seen. We could have gone on for quite a bit longer on this, but we'll spare you that. But anyway, please join me in thanking these guys for a terrific discussion.